Hello, this is Art Alvarez with Mortgage Works, where we have the answers and they're on the house. First, I want to wish everyone a happy 4th of July holiday as we celebrate 248 years of independence. Now, these days, refinancing your mortgage is a little different than it used to be. There's not a whole lot of refinances going on where you're looking to lower your rate. Why? Because you probably already have a very low rate first mortgage. So refis now are more about pulling cash equity out. So how do you do that? Well, it's more often the case now we're not refinancing your first mortgage, but looking at equity lending. And if you're over 55, there's a couple of additional options to consider. In fact, for that 55 or older homeowner who wants to pull out some cash equity, they have an existing mortgage. They may be handling that okay, but things are tighter than they were before. We have a great option for that homeowner to consider. It's called a Home Safe Second. And what that is a traditional fixed rate second mortgage recorded in, second position or junior lien to your first mortgage. The key difference, though, is you don't have to make monthly payments on the loan. And the qualifying is not as rigorous as it is with a traditional equity loan where you have to qualify meeting a debt ratio. What's the other benefit about this second mortgage, this Home Safe Second, is you don't have to pay off the loan until you either pass away or you vacate the home. So it's a really good option for that over 55 homeowner looking to pull that cash equity out, but otherwise doesn't want to touch their first. They think they're handling that okay. Now, when it gets into other scenarios, sometimes we're going to face a situation where we'll get a senior homeowner, that's someone over 62, who's looking to do a refinance. But in this case, they would be willing to consider, if they have an existing mortgage, get that paid off to eliminate the payment, and yet still at the same time pull some additional cash equity out. The best way to do that, of course, is a HECM, a home equity conversion mortgage, reverse mortgage. Now, this is an FHA product. And what's interesting about the product is it's still very much misunderstood. I'm often asked, what's the difference between between a reverse mortgage and a traditional first mortgage? Well, the difference is really not as much as you would think. First of all, they're both mortgage liens. They're both going to be recorded as a first mortgage on your property. The key difference between a reverse mortgage and a traditional mortgage is you don't have to make monthly payments on the loan, at least not unless you want to. We always try to stress that. There's no rule saying you can't make a payment on a reverse mortgage, but in most cases, the reason the homeowner's getting it is to eliminate mortgage payments altogether, and so it's not that frequent that people will make a payment on that. But understand you have that option. And the other thing that is very much misunderstood is reverse mortgages are perceived to be the type of loan there where the bank is going to own your home or they're going to take your home. Well, let me put it this way. That actually can happen with your existing first mortgage. And you say, well, how could that be? Well, if you have a first mortgage and you're making monthly payments and you suddenly stop making payments and you stop making those payments for a long enough period of time, what does that do? It triggers a foreclosure process. And what's the end game of a foreclosure process? The bank will take your home. So the point is, if you have a traditional first mortgage and you're worried about a reverse mortgage because the bank will own your home or take your home, well, you've got the same potential scenario with the loan you have now. The difference is how the loans are considered defaulted. With a reverse mortgage, it works a little bit differently. You're not required to make monthly payments. You can if you want, but you're not required to. And so what causes a default on a reverse mortgage when you're not required to make monthly payments? Well, the most likely scenario is you pass away. Or if you have to vacate the home for more than 12 months, that triggers a quote unquote default of the loan, and that requires it to be paid back at that time. Now, there's multiple ways you can pay off that loan, most often selling the home, but there are other options. And if you've passed away, all those options can be presented to your family and they can choose which one to do. So the point of it here is that a reverse mortgage, yes, there's a scenario where the loan goes into default and the lender could start the foreclosure process, but that's no different than the first mortgage that you have now. And the thing about a reverse mortgage as a refinance tool is it can help you eliminate your existing mortgage debt, remove any monthly payments going forward, and then allow you to pull cash equity in a multitude of ways, like payments over a specific term, lifetime monthly payment, and most importantly, a home equity line of credit that grows over time. So when you consider the reverse mortgage versus a traditional first mortgage, you start to see the benefits that the reverse mortgage can provide to that over 62 senior homeowner. So I encourage you to check into it further. We'd be happy to